The risk aversion that we're seeing in the current market makes it very difficult for you guys to judge the direction of the market, isn't it? Because it's just volatility.
Quite right. Very, very choppy indeed. And that's going to remain for quite some time, because a lot of the data that we're getting out of the US, out of Europe, all over the world, it's not consistent. You know, one day you get some really good data, the next day you're getting stuff which isn't looking nearly as good at all. I mean, today we get some nice data out of the US on the job front, for example, and that's great. But it's not really having too much of an effect on the markets. I think there's a lot of nervousness out there, and as you say, it's translated into high volatility.
ABSA today came out with headline earnings per share down 40%. The stock is at 19 Rand 50. It's closed up 0.75%. What do you make of this media company's fortunes?
You know, they have got some good assets in there, and notably the Sunday Times, and that, in my opinion, is what drives this thing more than anything else. If you look at other, what I would regard as more peripheral areas, the Times itself, they've reduced the loss there from what, 25 million to about 13 million. And you know, they're plugging away at this one. At some point in time, we're going to see it on the newsstands. They're going to be selling it for money rather than just giving it away. BDFM, you know, the Financial Mail and the Business Day, that's seeing big losses now, 25 million, doubling their losses from last year. So other areas not looking as well. Prakash Desai always starts off his presentations by talking about how the print media is dead and how they have to get into the electronic media, but I don't see it tangibly, and that's what concerns me about it. If I had to give an honest opinion, I suspect over time this would be a great target for another media group to come along, take it and carve it up into its component pieces.
Let's switch to the hospitality industry and how that's being impacted by the World Cup. Are we seeing the number of visitors expected? Are we seeing the occupancy levels that hotels across the board were anticipating?
Certainly not. They're nowhere near where we thought they were going to be even a few months ago. And I think a number of reasons for that. You know, this is the ultimate long-haul destination. It's far away, it's expensive to get to. And you know, you were talking about the strong rand earlier. I travel extensively around the world in the course of the year, and I find South Africa is becoming an increasingly expensive place to come. And that isn't lost on foreign tourists. So I think earlier this year, a lot of them probably took the view, let's rather watch it on TV. The crime aspect, although not as uppermost in their minds as we perhaps like to think it is also a factor. But nevertheless, look, we've still managed to attract a lot of tourists, and the hospitality industry going to do very, very well at the World Cup.
Well, one of the stocks set to benefit from the World Cup is, of course, City Lodge. That stock currently trading at around about the 75 Rand level. Earlier, we got some anecdotal evidence from Clifford Ross, the CEO of City Lodge.
For the World Cup period, I would say that we are probably on a par with last year, which is high 70s. Which we're very satisfied with. Obviously, it would have been better had had the hype which surrounded the World Cup actually come to fruition. I think the economic recession has certainly dampened the ability of people to come to South Africa, which is a long-haul destination. To come and follow their team here in South Africa. So if you ask if it's the boom that we thought it was, no, I don't believe that it is the boom that we thought it was going to be.
No surprise that we are seeing the economic recession having an impact on the World Cup and the benefits that we initially thought would flow from that event. City Lodge at 75 Rand, and they're listening to Clifford saying that we've got occupancy levels in the high 70s, pretty much the same level as the same period last year, which shows that the World Cup hasn't boosted those occupancy levels.
Bear in mind, they've put in the best part of 1,000 rooms in the past year. So, you know, they put in a huge amount of new capacity. So the other thing to bear in mind also is that the real benefit from a World Cup or an Olympics isn't in the year in which it takes place. It's in the ensuing years. So people come, they have a good time, and by all accounts, people have had a fantastic time in South Africa. So I think we can look forward, all other things being equal, to the next few years. Groups like City Lodge doing exceptionally well out of enhanced foreign tourism.
Joining us now is Cobus du Plessis, Director at the Institute of Behavioral Finance. Cobus, thank you very much for your time. You're going to take us through the Sanlam Investment Management Investor Confidence Index out for June, which is looking slightly more positive, and we're hoping that this is on all the positivity that's emanated around the World Cup. Can you give us your thoughts?
Bronwyn, thank you very much. Yes, certainly, I think since April this year, the Investor Confidence Index has been on the rise as such. And I think for June, I think there's two factors that greatly contribute to this. One is the fact that the markets have gone down slightly, so the participants generate shares as providing fair value, whereas in the past it was rated as being very expensive. If you look at the May survey, 50% of the participants said that shares are generally still very expensive. 48% sort of said provided fair value. In the June survey, 28% of the respondents said, shares are expensive, whereas at 19% fair value, with the rest reckon it's cheap at this stage, providing a great value. So I think it's more to do with the valuation of shares at this stage. That give
there's
rise
more
to
opportunity in the market now that we've seen a slight pullback.
Yes, and I think the other thing is, although it might seem sort of unrelated, the general sort of social mood in the country, I think has also greatly contributed to the sort of financial market optimism. I think there's enough research to show that if you generally sort of, the social mood is great, people feel confident about other factors like the financial markets and making investment decisions.
Chris, do you believe that there's value in the current market at the moment, as the index is showing us? Well, that largely investors are looking for value?
PEs are still a bit on the high side. They're higher than the average for the past 10 years or so. So there are pockets of value, but you have to be much smarter than you were a year or so ago to try and find that value. Generally speaking, the market is a bit still on the pricey side, even though it's come off a bit.
Has the number of people expecting a crash subsided in this confidence survey?
Yes, during May, approximately 20% of the respondents still felt there was a possibility of a crash. And if we sort of say what's the possibility of a crash, that's people thinking that there's a greater than 10% chance of a crash in the market, and that's gone down to 15%. In terms of sort of market returns, I think that there's also been a great, people have to give their sort of future expected value or returns on the market over 1, 3, 6 and 12 months period. And that's both from financial planners and what we call institutional investors. Now, institutional investors being economists, analysts and portfolio managers that normally look after markets. And generally over the 6 and 12 months period, they've also expected, that the returns over the next 6 to 12 months is positive.
Well, you come to my next question. Yeah. Is the longer term expectation from the market that we're going to see a continued positive trend, or is this just an artificial boost with the social mood improving around the World Cup?
One thing that I try and refrain from is sort of forecasting, because in general, if I had to speak to an investor, it's probably the ideal time for them to get into the market and invest at this stage. But due to the volatility, you probably find that a lot of people keep out of the market. Now, it's difficult to say. I mean, if I look at the past, over the past 36 months that we've done the research, generally when there's optimism in the market, people are over-optimistic. When there's pessimism, people are sort of over-pessimistic. So you generally find that people with a level of volatility and still some pessimism, people tend to stay out of the market because there's over-pessimism from the investors' perspective as such. Going forward, I think there's enough reason for people to get into the market.
Because you're still saying that the market is looking expensive. The PE on the market is expensive right now. Perhaps it's not the most ideal time to enter the market.
I think there are, as I say, there are pockets there. But I mean, if we take the retail sector as a proxy for this, I think what's happened there is a lot of investors have jumped in because of what they perceive happening in the economic cycle, that interest rates are going to keep on declining or plateau or trough out, should I say, and as a result, more and more consumers are going to spend. I think they probably anticipated a bit too much, uncertain of those stocks, and as a result, they're kind of high. I have no doubt that in the longer term, the value will become apparent, provided, of course, that we stay on an even keel as far as the economy is concerned, and we don't go to double-dip recessions in the rest of the world.